Well, hello everyone. Happy Friday. Welcome to Trading a Smaller Account. And as many of you know, I have been off for the last month and a half working on the BARB 2.0 project, which included a new knee, which is doing just swimmingly. But I gotta say, I've missed all of you, and I have particularly missed teaching this class. So it is really wonderful to be back. We're starting with somewhat of a clean slate, but today we're going to look at the good, the bad, and the ugly, and the promising, and kind of everything in between. I hope you guys are all buckled up because, as usual, I have a lot of stuff that I want to talk about today. And so I hope you guys have flexed your fingers, gone and refreshed your drink or whatever beverage you're drinking, and you're ready to roll. If you are not following me in the land of X, I encourage you to do that. I also posted something saying, hey, follow me. If you aren't following me on X, you're going to want to follow me and then ask me to follow you, because most of what I post, you'll only be able to comment if I'm following you. So, and I'll post something on that, another invitation to ask me to follow you next week. So my handle, Barb Armstrong CS. Anyway, it's good to be back. Let's get right down to business. As we do that, note, this is a small account class. It's an active trading class. And so if you're new to this, please feel free to type a greeting into the chat so that we can welcome you to this community. But we do trade both stocks and options in this, and know that options carry a high level of risk and aren't suitable for all investors. Also, you have to apply for option trading privileges with Schwab, and not all will qualify. We use the Paper Money software application on the Thinkorswim desktop platform, which is a brilliant place to be able to learn and hone your skills prior to considering trading in your live account. Now, one of the nuances or differences between Paper Money and a live account is that short positions will never be assigned early in Paper Money. That can happen in a live account. And so we discussed that. We've got Connie Hill with us in the chat today. You guys, I know, will know Connie if you've been here before, because she covered this class for the last 6 weeks and did an absolutely fabulous job of it. So, James Boyd and Kevin Horner did a great market overview this morning, so I'm not going to spend a lot of time on that. We're going to focus more on managing, and we only have 2 trades that I'm going to talk about on the management side. And we're going to spend most of our time placing new example trades. Okay. And then one announcement, prior to this Dallas market drive in September, there is a 2-day event happening in DC, but that is already filled to the rafters and registration for that is closed. So if you live in Dallas, Chicago, or Orlando, or would like to visit any of these places and join us, we're doing these market drives. They're 1-day events. I'll be at the one in both Dallas and Chicago, these market drives, and, we'll have the coffee on, we'll provide breakfast, we'll pay for your parking, we'll provide lunch. There's a great reception at these 2 events at the end of the day. And we kind of go from an overview of what's happening globally in the market. Sorry, excuse me. An overview of what's happening globally in the market to looking at what's happening within our country, how tariffs and other things might be impacting that, down to how the sectors are reacting, the whole bit. And then we'll get down to individual stocks and how a trader might try and, look at, things in the context from globally down to an individual stock level. And example trades are placed just to kind of round everything out. So it's really a great thing. I don't know if I'll be showing my new knee, but I'll certainly be there, giving it a spin. So might cost you to actually see the scar. Anyway, that's that. So let's get out to the market and have a look. So here's our S&P 500 up 1.6% today. And even though people get a little angsty when the market pulls back, especially when it does that for 5 days in a row, but Chicken Little is still, back in the barn. No sign of her yet. and many would argue that this is perhaps a nice bull flag pattern setting up here, right? Right. So, we've had an extraordinary move to the upside since April 7th, and we're close to all-time highs here on this index. And the NASDAQ, the same. Yeah, so Cecilia, welcome. We've got some people here for the first time today. So we hope you'll continue to come back. This is a really great community, and we meet every Monday and Friday. The NASDAQ, kind of the same type of situation. We had this kind of bull flag type pattern that appears to be setting up, and it's not as close to its all-time high maybe as the S&P, but we're certainly seeing a pretty bullish pattern setting up here. And I've got the 10-day and the 30-day moving averages here on the chart. Okay, so I said I wanted to look at two positions. So when I came back, and what we did is, Connie, when she took over for me while I was gone, decided to just look at kind of start afresh. And so I came in and said, oh, I wonder what is still in this account. And when you come to the monitor tab, we can see that we had done a buy right covered call. So that means we did this as a short-term trade where we bought 100 shares of stock and then we sold a covered call against it. And when did we put that position on? Well, if we come to view trades, we put it on April 2nd. And, if we look here, it's saying we're up 64%. We've made $2,400 on this trade. And our account started at the beginning of the year at 25,000. So this is close to a 10% return, representing a 10% return. And this is an unrealized gain on the entire portfolio with just this, on the entire account with just this one example trade. And we don't have a stop on this. How do I know that? Well, because there's no little chiclet over here with a sell order. And so my guess when I looked at this was, hey, we probably sold a covered call and it expired worthless. And if we come over here to account statement and I type in Celsius, so you can see we actively trade this account. So here's what we did on April 2nd. We bought 100 shares of stock for that $37.29 and we sold the 40 covered call for $276. So this amount that is showing that we were up on this trade does not include this 276 for selling the 40 call. And then we came out here and we bought it back for 23 cents. So we sold this call. Okay, why is this not working for me? Let me just make this a bit bigger. Okay. So we sold this call for $276 and we bought it back for 23 cents. And so we added to our profit on that $2.53. And then you can see we sold this 42 call for $1.16. And then we bought that one back for 35 cents. You can see up here are 35 cents. So we bought that one back for 35 cents. So we made another 81 cents on that, a share, or $81. And then we sold this 120 call. We sold the 42 call. So we bought the 42 call back for 35. We sold one out from June 6th to June 20th for $1.20. And then we rolled it from the 42 call to the 45 call, thinking, well, we could make $3 more, and we got a 21-cent credit. And so the last two, then this one, we added the 21-cent credit for a total of $1.41. And then that ended up expiring worthless. So when you add all of this up, it added another $475 in covered call profit to our total. And so this has been, somebody said, I'm ready for the base hit brigade because we do, our goal is to do a lot of base hits where it's like little wins, little wins, little wins, and they add up. And this isn't just a grand slam, like a bases loaded home run. This is like bottom of the ninth for the World Series win kind of, kind of success story on this one. And does this happen often? No. And really, why did this happen? It was a little bit of kind of benign neglect, if you will, because I was on leave and we weren't looking at this account. And, so it expired on this day. We had the 45 call, and it closed that day at 44.43. And then it took off like a rocket. And so our first covered call, we sold at 40. Now, if we wanted we want to protect ourselves to the downside on this, right? Because we still have it in our account. And could you see a situation in your own personal life where you might have a surgery and be wildly optimistic and think you're still going to look at your stocks and then you don't, or there's an accident or whatever? Life keeps lifing, right? So we're in this situation. It hits an all-time high today of 63, or it may not be an all-time high. Let's come back. We look at a 3-year chart. So it's certainly not an all-time high, but it's a recent high of 63. So could we come up, and I'm just going to kind of come in a little more up close and personal, and maybe sell the 65 call? And then where might we put a stop? Because we don't want to go back to this 30-day moving average, but we could say, well, hey, halfway through this candle, when you have a big candle, that's considered to be a support level. And, it pulled back. So if we look at around this 59.50 level and go 3% below that, so I'm just going to take 59.50 times 0.97, which would give us 3% below. So 57.71 is going to be our stop. And then let's see, it's at 61.62. Could we sell the 65 call and get enough premium for it to be interesting? So if we come out to September and we look at the 65 call, well, there's 3,000 contracts. So there's a lot of people maybe with a similar idea out there. And we've got a 5-cent bid-ask spread. They're saying there's a 30% probability of it being in the money at expiration, 31%, a 63% chance that it could come up and touch it. So if we're saying, well, we only intended for this to be like a short-term dating strategy, not a long-term love affair. So if we could make another $340 on the upswing in the stock and get paid to sell the stock, we'd be okay with that. So we're going to come out here and we're just going to sell one covered call. They're saying they'll give us $1.50 for it. Okay. So confirm and send. And we're going to put this in our buy right covered call. Something weird is happening with my Thinkorswim today, and it's not letting me bring up most of the drop downs. Okay, so when this fills, then what do we do? Then what we do is we can go in and put in an exit. Okay, so now it's filled. Now, if you don't have this in your paper money portfolio, could you just buy 100 shares of Celsius and sell a covered call at the same time? We call absolutely, and that's how we started on this journey. So we're going to come over here. We're going to move this to our buy rights. And then, oops, I can do this. We're going to create a closing order to close out the whole thing, to sell our covered position. And when are we going to do that? Well, we're going to do this at the market price because we don't know how much we have to pay to buy back that covered call. And we're going to come to our little disappearing, reappearing sprocket and say, we want to sell, we want to exit this position if or only if this stock goes below 57.71. So we're giving it a little room to breathe, but the goal here is to protect the majority of our profit. So we've got, we want to exit this position. It's good till canceled to close it out if Celsius goes below 57.71. Okay. And so that will put our stop in. And so if we come out now, we'll see that little chiclet there. And so, is a stop guaranteed to get us out at exactly that price? It is not. But what it will do is trigger a market order, so it will get us out at the next available price where the stock to gap down. Okay. Now there's one other position I wanted to review, and Connie put this on, and she talked about this yesterday in her short vertical class. But if you weren't at that class, first of all, where were you? Because she does a great job with that short vertical class on Thursday afternoons. But in this class, she had put on a short put vertical on VKTX. Now, Viking Therapeutics, this is what space is it in? Let's come to the analyze type. It's in the healthcare, and it's a biopharmaceutical company. And apparently they were working on a weight loss drug, and the results came out and the efficacy rate wasn't what they were hoping it would be. And the stock didn't react well to that news. Okay. So it took a dive. Now, here's the deal with a short put vertical. If you're not familiar with the short put vertical strategy, and this is considered to be, an intermediate level class. I do my best to speak in English, but kind of the expectation is that you understand already a lot of these strategies. So when we put this trade on, let's say we put it on here, we were expecting the stock to stay above $35. That was the expectation. So we sold a put here, which means we're agreeing to buy the stock. We're saying we'd be willing to pay $35 a share for the stock. And then just in order to define our risk, because at $35, we could be put the stock and it could go all the way to zero. So we're risking $3,500. We bought a put, which means buying a put gives us the right to sell the shares at $32.50. So now our max loss on this, theoretically, is $250. And somehow my drawing tools are just acting up today. So, and what is fascinating to me, because I would have thought, well, I'm just snookered. Like this is now max loss. But surprisingly, it isn't. And this is not an 8, this is a 5. So it's 250. Our max loss is 250. So we have two approaches, and one is we can just wait and we've got until September 19th. And so wait and see if the stock rallies. But after this kind of devastating news, do we think that it's likely to move up $10? It has to move up. Like it's at 25.74. It has to go north of 35. It has to go above 35. And the probability of that is probably not very high. And so let's just see, for giggles, if we were to close this out now, what would it be? So if we come to our trade tab on VKTX, and Connie said in her class yesterday, this is just a good example of, don't just look at the chart, be aware of what you're trading. So I had somebody who, when they first told me about the buy right covered call strategy, one of their rules was you didn't trade it over earnings, because they wanted it to be a higher probability, lower volatility, lower risk kind of strategy. And the other thing was no biotech stocks, because this kind of stuff can happen with biotech stocks, right? And so you might say, well, I'm going to adopt that rule, and I'm not going to do biotech stocks for short verticals for that reason. And you might say, well, you may want to have that rule. I think it's a dumb rule. Well, you can make whatever rules you want. But if we look at this and I look at selling a vertical, if I just want to go 1 month, I wonder, let me just see if this will work, because it's not letting me 35.33. Now I can change it. Okay, so it's at 237. Now, earlier this morning, it was at 225. So max loss would be 250. And so if you just did one contract, you may say, you know what, I'm just going to cut and run. Like I said, the first thing this morning, it was around 220 to 225. So if you did 4 contracts, you could be saving yourselves $100 by exiting the position. 4 contracts, if it's at 235. So let's say we, lock it in at 235. So, you could be saving yourself on 4 contracts $60 if you were to exit at that price. And so this is one of those things where you just have to make a decision. And I was driving around and listening to Bloomberg radio one day in my car, and they had this CEO of this investment company on, and he said, do you have any words of advice? And his one word of advice was, when you are wrong, admit it quickly and exit quickly. Because he said, even the best of the best are not right all the time. Maybe the best of the best are right 70% of the time or 65% of the time. Even if you're right 80% of the time, it means 20% of the time, your trade didn't work out. And admit it quickly, because a small loss beats the stuffing out of a large loss. But, we're close to max loss here. So you might say, hey, for $15 a contract, I'm willing to just, I position sized appropriately to begin with. And so I'm just going to see if it might recover. And, as part of making that decision, you may want to go and read the recent news. Okay. So that's that. Now, so there's the good and the bad and the ugly. There's the good, the bad, and the ugly. Okay, so let's look at some new positions, and let's look at Spotify. So this is a service that, my kids gifted me Spotify years ago, and this isn't a recommendation, but it is probably the gift I've been given in life, other than life itself, that I have used almost every single day. And so, Spotify, when we look at this stock, it is up 53% year to date. So it's having a pretty good year, I would say. And then we saw this pennant pattern setting up. And, if you're newer to this whole world of trading, we talked about pennant patterns and triangle patterns, and how a trader might consider trading those in the Getting Started with Technical Analysis Tuesday. I'll put a link into that class at the end. But, we saw this breakout, and then not uncommonly, it kind of pulled back. And then in that Getting Started with Technical Analysis and in the trade management mini sessions, there are a bunch of, we talk about candle patterns. And this pattern is called a bullish harami. So it's happening at a support level. And this candle, and this is still a live candle, so who knows? It could change, by the end of the day. But, this candle is inside the body of this candle at a support level. And so this candle configuration actually does not require confirmation, according to the candlestick people, whoever they are. Okay. So if we look at this and could we say, well, could we do a short put vertical maybe down here around 680? Or maybe if we're bullish on this, and, even though this was a consolidation pattern here, it's part of a larger uptrend, right? Right. So let's come and look at September. So we're 28 days to September 19th, which is the monthly. What's the advantage of looking at monthly contracts? Well, the advantage of looking at monthly contracts is that you tend to have higher volumes on them and sometimes tighter bid-ask spreads. Now, this one is still over $1, but it's a $23 contract. So is it less than 10%? It is. So could we look at this, 680? And what's the problem here? Well, the problem is if we go up, we have $5 wide spreads. If we go down in price, the spreads are $10 wide. And we can't afford to do a short put vertical that's $10 wide. Why is that? Well, because, chances are we're not going to get paid more than maybe here's $4, which is a pretty darn good return. But what's the gotcha is that we're risking over $700 on this, over 600. And we don't want to risk more than 500, maybe 550, and so either you have a rule and you follow it, or you don't have the rule. And our rule is we don't want to risk more than 500 to 550. We're not going to risk $620 on one trade. So we can either just say, okay, we're not going to trade. Or we could come out and say, well, if we come out 21 days, we've got 16 contracts. That's a little light. We'd like to have 20, but we have under $1 bid-ask spread. That's not bad. So could we do the 680, 675? Because here we can do a $5 wide spread. And we're getting paid $1.92. We've got $15 worth of wiggle room in that, or $14 worth of wiggle room. And by wiggle room, I mean, this is a bullish to neutral strategy, but it can move down by $14 before it's in the money. And what do we want for return on risk? Well, we want at least, a 21% return. And if we can make $1.92, how much can we lose? Is $5 minus $1.92. So if I divide that by, what is that, 308? That's a 62% potential return on our risk. Now, how many of these contracts could we do? We can only do one, because if we do two, we're back up to over $600 worth of risk, right? And so we're going to say, hey, when I've got 80% of my max gain, I want to take my risk off the table. So when this gets to the point where it's worth about 38 cents, now, some people might say, I want to let it expire worthless. You're leaving your risk on the table, until the bitter end. As some might say 90%. Some might say, hey, if on Monday it's gone up 50%, and I was willing to be in it for 21 days and I was in it for 3, one of the advantages of short verticals is that time decay continues over the weekend. So one of the nice things is we've got, a holiday weekend coming up where the market's closed for 3 days. So that's kind of a bit of all right, because we're getting time decay when the market isn't open. So we're going to put that in our short put vertical bucket. We're risking 308 to make 192. And this is a weekly. And the reason we chose the weekly, was because it offered us a smaller strike width. And so here, if we want to put this on the chart, we can say, okay, this is 680. Whoops. This is our short put vertical at 680, 675, expiring September 12th. So now when we look at the chart, now sometimes we'll compare and contrast trades. Now, if you're feeling very bullish on the market in general, and Spotify in particular, even with a small account, what else could we do? This is a $700 stock. Could we do a long call vertical at maybe 690 and 695? So it only has to go up by, $1.70, because the goal is for it to be above both our strikes. And what would we have to pay for that? So could we do and here, well, this is September 12th. If we came out to the monthlies, we could, we've got 299 contracts there. These contracts have probably not been available very long. The ones in, because you'll see 2,200 at the $5 strikes, there are fewer. And it's because they just recently became available. But if we buy this vertical here, we'd pay $260 for it. Okay. And our goal on these for a long time was we wanted a 50% gain. And then, the market, there was just a lot of volatility. And so we said, how about a 25% gain? And so you can make it whatever you like. If you look at our example trading plan for long call verticals, we're looking for a 50% gain. So that would mean if we make this first trigger sequence, and here we could do 2 contracts, which would have us risking, because we could lose this entire amount. So that would have us risking $520. We're going to create an opposite order and say, hey, when this gets to $3.90, we want to buy it back. Now, to the flip side, we're going to look at these on a daily basis and say, and if it goes down by 50%, then we want to exit. Okay, Dragon Rider. Yeah, so the reason that we look at open interest is because we want to kind of run with the crowd. In that if there's more liquidity, it is likely for a trader, for it to be easier for the trader to exit the position. And so when we have lots of volume here, and that's why we look at that, to just say, and that's part of our rule set also, is that we want a certain number of contracts and we want a bid-ask spread that is less than 10%. So this one is, 20, this is $1.50, the bid-ask spread, but it's a $30 option. So it's about 5%. Okay. Okay. So we're going to send this in, and then we're going to compare this, the short put vertical and the long call vertical, which are both bullish strategies. So we're going to say we're going to compare this to the short put vertical. Okay. Now I want to look at Newmont, and so sometimes in class we have a theme, and the theme, we're just looking at all diagonal resistance breakouts, or we're having a short vertical day or a long call vertical day. Today is kind of a bit of a dog's breakfast in that we're looking at a lot of different things. And I know some people are really comfortable trading options and some people are not. And so I thought, well, let's look here at Newmont Mines. So, and what kind of company is Newmont? Well, I spilled the beans. It is a mining company. So it's in the materials sector, and it's a gold mining company. I mean, this is what they're known for, right? And it also does copper, silver, lead, and other metals. They have mines in Canada, Mexico, the Dominican, the US, like all over the world, and I didn't realize it's headquartered in Denver, founded in 1916. So this company's been around a long time. Just a bit of trivia you may not have known. I am from a gold mining town called Kirkland Lake. That's where I was born. And it is not the end of the earth, but you can see it from there. We're talking Arctic watershed, my friends. It is way north in Ontario, Canada. Anyway, so Newmont is hitting a new high today. And I believe on this one, it's a multi-year high. So if we look at a longer term trend, it's had its struggles, but we've had this big, and this one started like 3 years ago, setting up this big inverted head and shoulders pattern. It was at one point up at 86. This was back in April of 22. But if we're looking at the shorter term, could we look at this and say, well, what if we did this as a stock trade? And I'm going to just change my price axis to add a bit of space at the top. We don't need space at the bottom. Okay. And what if we, because we don't have a recent target to aim for, like if we wanted to do a swing target or something like that, but we could come over to our friend, Mr. Fibonacci, and say, well, if we look at this as kind of a bull flag, extended bull flag pattern, whoops. So if we make our target this 161 extension, this would give us a target of about $75. Yeah. So, and you just click at the top and drag down, to the bottom of your flagpole. And so this gives us a target of $75. Now, we have two position sizing rules in this class. One, we don't want any particular, any one trade to risk more than $500. The second thing is that we don't want any one position to be more than 5,000. So as much as we might want to buy 100 shares, that would be 7,000. That's too high. So we're going to say, well, if we could buy $5,000 worth of shares and I divide that by about $71 a share, we can buy 70 shares. Now, if you're saying, well, only a poser buys less than 100 shares, well, then I'm a poser. That's okay. Like we can, do just quite fine. Thank you very much. Buying less than 100 shares. Now, the one thing that's nice about buying 100 shares is that then come earnings time, you can use a protective put if you like, you can sell a covered call, so this is why sometimes people like to buy in blocks of 100. And if I was able to buy 105 shares, I probably would just buy 100. But I'm not going to blow my budget, have such a blatant disregard for my rules by going that far over. But we're going to come in and say, okay, here's our target, and it's based on this Fibonacci of 7505. Okay, now where might we put a stop? Well, that's a good question. So we could come back and use the Fibonacci's, but we could also just say, well, whoops. Let me get rid of that. We have a recent support level here around this 67.13. So maybe we could put our stop 3% below that 67.13. So 67.13 times 0.97, which represents, if you multiply by 0.97, so our stop, just writing it down. I have a great memory, but it's short. 65.11, because somebody in one of the comments on an archive that they watched had said, well, why do you multiply by 0.97? And it's because it makes that number 3% below. Now, could you use 2%? Yes. Could you use 5%? Yes. You can use whatever you like. But, just as an example, we said, hey, we're going to do this. And some might also say, I'm going to change my drawing here, that, it's funny how you tend to see what you're looking for. But we had a little bit of a triangle pattern setting up here also, and it broke out above that yesterday and is continuing to move to the upside today. And so you might say, well, if you put in a target of 75.05, like that's not that much money that we'd be making. But you say, well, let's make our target 75 and we're getting in for 70.87 or thereabouts. That's a $4 profit if in fact we end up with a profit. And if I divide that by our price to get in, that's 5.8%. Beats a poke in the eye with a sharp stick. That's not bad. And how long might that take? Well, it could take 4 or 5 days, and it could take, 6 months. And it also could never get there. Like it could end up coming down and we could end up stopped out. At which case, if our stop is at 65.11, instead of making, 400 or so, 40 some dollars a share, we could be losing $5 a share. So you got to look at both sides. So we're looking to buy custom with an OCO bracket. And how much are we buying? We're buying 70 shares. Why 70? Because our rule says no more than $5,000 worth. And then I'm going to click this little paper clip. And then when I click anywhere over here, it'll line up the quantities. And so we're going to make our target here 75. And our exit is going to be 65.11. 65.11. Confirm and send. So we want to buy 70 shares, that position size $4,961. And we want to sell it if it goes up by $4.11 or down by $5.78. And we're going to put this in our stocks with a target. And this is a Fibonacci target. Okay. Oh, you know what? I meant to put that in. Well, you know what? I will send that order in. Saved orders. So I will put that order in after the class. I meant to hit send. But what have we done? So we've done a trade on Newmont Mines, which is a stock trade with a target and an exit. And then we sold a covered call on the one existing position in our account. So somebody's asking, are these real trades? They're real example trades in a paper money account. And then we'll come back on Monday and look at managing these trades. We'll have a quick look at our short put vertical and our long call vertical, but it's all happening in a paper money account. Okay. Yeah. So we did a covered call on Celsius. And if you don't have that in your account, you might want to do a buy right covered call in your paper money. And then we did a short put vertical and a long call vertical that we'll compare on Spotify. And then we did a stock trade with a target on Newmont Mines. So I'm delighted to be back. I want to thank Connie again, not just for her help in the chat today, but for all she did when I was away. She was pretty darn busy and covered a lot of the classes that I teach. One thing I wanted to show you guys quickly, if you haven't ever registered for an in-person event, if you come here, just come to schwab.com and there will be a link to this down in the show notes below if you're watching this in the archives, and I've just put it in the chat, and you can see all the in-person events coming up through the end of the year. I will be at most of them. We end the year in Miami, begin December in Houston. We're in Anaheim in November. And then Orlando and Chicago in October, and Dallas and DC in September. The other thing I wanted to say is you want to subscribe to the Trader Talks channel from Schwab Coaching on YouTube. And, so if you just type in Trader Talks from Schwab, there'll be a button in the bottom right corner of your screen. I had referenced a couple of playlists, and one is this trade management mini sessions. Okay, it was right on the side. Here we are. And so we placed a number of different types of trades today. Somebody's asking if these events are free, and yeah, you just have to get yourself there. So if you click on view full playlist, so there's a bunch of short candlestick patterns. These are all like 2 to 5 minutes long. And, we look at what is a hanging man or a hammer or a bullish engulfing, that kind of thing. And you'll see those start to grow again now that I'm back. And then here in blue is a bunch of example trading plans. And so there's an example trading plan for long call verticals. There's one for short put verticals. There's one for buy right covered calls. There's one for stock investing. So, if this is your first time, and if you're new to all of this, if you scroll to the very bottom, there's a whole bunch of quick tutorials, all typically between like 7 and maybe 12 minutes long, on different components of the Thinkorswim platform. So there you go. Okay, so guys, that's a wrap for today. Thank you for joining us. Hit the like button. It helps move this up in the algorithm. Don't forget to subscribe to this channel if you haven't done so already. Follow Connie and I, Connie Hill CS and Barb Armstrong CS in the land of X. And if you haven't done so already, get out and hug someone you love today. Have an awesome weekend. And I will look forward to seeing you on Monday for more Trading a Smaller Account. Take care, everyone. Bye for now.